I hope everybody's having a great time. The sun has come out just in time for our panel.
Yeah.
That's the important thing. That's what we care about. This is beautiful, sunny California. And I want to give a shout out to Barry and to Josh Brown, both friends of mine. I came here last year because they're trying to figure out a way to reinvent the financial conference. I don't know how many people go to them. The people up on this panel, we go to financial conferences all the time. Let me tell you, they're getting a little long in the tooth. They're getting a little boring. They're not diverse enough. They're not interesting enough. And Barry and Josh decided to try to invert the idea. The idea of the old financial conferences, everybody killed themselves to get them big stars, like these guys, on the stage. Big guests. So people, it's the content that made people want to go to these conferences. And what Josh and Barry said is, you know what? We want younger people. We want more diversity. We want younger investors. We don't want just professionals talking to professionals. And let's try to invert this idea. Instead of let's kill ourselves over all the content, let's make social interaction. Let's make socialization as much a part of the whole thing as the content. And they sort of inverted that idea. And they said, let's put it on a beach. And everybody said, you can't do that. That's kind of crazy. Last year, there was 2,000. I'm going to tell you, I just got a message from the organizers. They're hitting 3,000 people here for these 3 days. So it's been a great idea. And it's a great idea to try to reinvent socialization and reinvent the financial conference and educate people. Most of the people coming here are RIAs. They're some kinds of investors. They want help with organizing their business. They want help with the front end. They want help with the back office. They want help with selecting what kind of investments that would fit their clients' need properly. Some of them want legal issues, but people need a lot of help. And I'm going to tell you right now what kind of business you are all in. Most people say, oh, I advise people on the stock market or bond market. That's true, but it's a very small way to look at things. These people up here and you people, you're in the dreams business. You're in the business of making people's dreams come true, whether it's putting their kids through college, whether it's a happy, healthy, safe retirement with enough money for them to not gnaw their fingernails and worry about it, whatever. Think of it that way. You're in the dreams business. And when you think of it that way, there's an awful lot of responsibility on all of us to try to help people accumulate wealth and the right way to accumulate wealth. Today we're going to talk about the global macro situation. We're going to give you a sense of what's going on in the world, what's going on in China, what's going on in Europe, what's going on in the United States, what's going on with inflation, and a little bit about what's going on with the Federal Reserve. Now, Barry's introduced the three panelists, so I don't need to introduce them. Jeremy Siegel, unfortunately, couldn't be here, but Jeremy Schwartz, who co-wrote the new edition of Stocks for the Long Run with Professor Siegel, is here. Jeremy, thanks for joining us at the very last minute. And those of you who don't know anything about Jeremy Siegel, as a man I've known for 25 years, go out and get the new edition of his book, Stocks for the Long Run. Jeremy Schwartz here co-wrote it with him. It is one of 5 investment books that sit on my desk as a reference. There's very few reference books I use anymore. After 33 years at CNBC, I don't need a lot. I have 5 of them. This is one of them. I strongly urge you to go out and get one and learn about the history of the stock market, because he became quite famous 30 years ago with studies on stocks and bonds going back 200 years. You want to talk about long-term investing, that's the way you want to talk about it. So let's start out talking a little bit about interest rates. Emily, the story of last year and now has been rates stay high. Rates are high, and maybe they'll stay high. So will they stay high? What's the story about the rate situation?
Yeah, so thanks, Bob, for having me here. Really excited about this, and this format is, I think, really exciting as well. So I think we have to start with what happened, what the story was last year, and it was that fixed income investors got absolutely crushed. Last year, we had the aggregate bond index return negative 13%, which of course was the worst year in history. And of course, it was a result of all of the biggest bond enemies coming together over the course of the year. Of course, higher inflation, higher commodity prices feeding into that, and an enemy number one, which was I probably shouldn't call the Fed enemy number one publicly, but the Federal Reserve raising interest rates to the highest extent in the shortest amount of time that we've seen in over 40 years. So all of the worst things that happened to fixed income investors, or could happen, happened last year. Now, I want to turn something else sort of on its head. We often think what to ourselves when we see a correction in equity markets? We all get pretty excited. Why? because we're going to be able to buy all the stuff that we really like at a much cheaper price. And I know Jeff's going to talk about that as it relates to international equities. Now, we never think about bonds like that, right? We just saw a once-in-a-lifetime backup in bond yields, and now they have something that they haven't had in a long time, which is income. So we look at the aggregate bond index yielding over 5% right now. We think that you can get paid to wait as this challenging macro environment plays out, which I know we'll talk about. Embrace bonds. We're creating the hashtag right now, bonds and chill. I think bonds can do more heavy lifting in portfolios as we wait out a recession that we think is increasingly likely to unfold here.
Are we going to see 10-year yields 4%, 5% the next year? Where is it?
I think it's 1 to 2%. So if you look back at the last, you look back at the last 4 cycles, the 10-year Treasury yield peaks right around the same time or just before the Fed pauses. And I think we can debate this, but I think we're right around there. And from there, it falls on average 2.65%. So if you do the math, that gets us down to about 2%. It's not perfect, it's back of the envelope. That means duration from here could be an extremely powerful tailwind. If you'll let me do one more thing here, I want to do a little math. Maybe a little, it's back to school time, right? I think my kids have already been not turned their homework in. But if you think about right now, think about the aggregate bond index, back to that, just over, let's call it 5%. And if I'm right, and the 10-year Treasury yield has a 2 handle on it, or let's just say 3, duration's 6 years right now. So you go, again, from 5 to 3, you're talking about a 12% return just on the duration. You add the 5% back in, 17%. That is the best math I can do across any part of the capital markets right now. So that's why we have a slight preference for fixed income.
Okay, Jeff, my mother called me at the end of March. She was the head bank teller at her bank for 20 years. And she was there with the head teller, as a friend of hers. She's retired, my mother. And she said, Robert, they're offering me 4% yield on my 1 year, on a 1-year CD. And she said, I was getting 0.3% of my bank account. This is amazing. And I said, well, Mom, welcome to the new environment. The banks are not happy because they're going to have to compete for their money now. And they're not happy if you start pulling money out of your bank account and putting it in 1-year CDs. They're going to have to pay you more. And she said, Robert, I could care less about the profitability of the banks. I've got nothing on my savings for 15 years, and I'm doing it. And she started pulling money out. And she said, you know what? The bank teller tells me to wait another week because she thinks yields will go higher. I said, Mom, do not be a bond arbitrager, please. Just figure out, if you're happy, the 1-year CD is going to make you happy. So what's your attitude right now? Isn't it amazing, this persistence of money market funds, how strong it stayed, how strong the inflows into short-term treasuries have been remarkable?
I think it could be a bit of a roller coaster, though, in terms of where short-term yields go. And I say that because we know inflation's come down pretty sharply. But I think inflation is going to be a lot more volatile in the next 10 or 20 years than what we've seen over the last 20 years, right? It was very low, very stable. We don't have the same drivers. Forget globalization for a second. Forget tech for a second. Those drivers, I think, are still in place, maybe a little less so. But it's the labor market, I think, that's so important to inflation. We had a glut of labor for so long. First, the Berlin Wall came down, and we had 900 million people come into the global labor pool. Then China entered the WTO in 2001, and we had 1.1 billion people enter the global labor pool. That's not replicating. We're not going to get that out of India in a short amount of time. We're not going to get that out of Africa, of Latin America. And so we don't have cheap labor to count on to help keep inflation low in the same way we have over the last 20 years. So while those yields look attractive now, they may continue to come down. They may go back up again, go down, go back up again. I think it's going to be a bit more of a roller coaster ride, I think, for near-term yields.
You think yields are going to be back down in the next year?
Right.
And you think it's a roller coaster?
I'm looking, down, up, down, up. I think we're looking at a higher average level, but a much more wild ride than we've been used to.
Can I just respond to that?
Go ahead.
The only thing I would think about here is absolutely nothing has changed except we pumped $5 trillion of stimulus into the economy. The last 20 years, we've been in a low growth, low inflation world, low rate world, and technology development in AI has certainly been a huge part of that. So I think once we can unwind the pandemic era stimulus, we go back to that environment that we've been in for the last 20 years.
2% growth.
Yeah, which by the way was awesome for stocks.
Yeah. Jeremy, weigh in on this.
You know, it's interesting. Emily said that we're going to set up a bull-bear debate here on the economy and maybe rates. But it's interesting. What Emily just described was also a feature of what the book that Bob just talked about in Stocks for Long Run. There was a whole new chapter on the lower for longer interest rate phenomena, and some of what you described of, like, where should the long-term equilibrium real rate be? Where should the 10-year TIPS yield be?
This is the infamous R-starred story, right?
It's somewhat the R-star and also just that longer term interest rate. So R-star often at the Fed and is at the short end, but if we're talking about the long end, 2% on 10-year TIPS is a pretty reasonable number. I mean, it's basically higher than it's been on average since '97. Your world of 2% on the nominal is basically zero real, which is actually somewhat what Siegel was talking about before recently. He was thinking that rates would come back down to 0, maybe 50 basis points on the 10-year TIPS. Now, he also came in expecting that the Fed being way too tight, we think the Fed should stop. We've been saying inflation is less of an issue. We have our own calculation of inflation that uses real-time data for Schiller housing and Zillow rent instead of the shelter inflation, which is 7.8%. Our numbers are like 1% for shelter inflation, which would give you, basically there's no inflation. Core inflation would be 1.7 and headline 60 basis points, right? So our numbers are much lower. So there's a world where you could say, hey, 2% is a real attractive value.
Right. And for people who don't follow this, I know we're getting a little in the weeds here, but TIPS is essentially the return you're going to get on a 10-year over the rate of inflation, essentially. CPI is what they're using.
Yes. And so
2%, the point is, it was negative.
It was negative 1.5.
Yeah, so you were actually losing money holding on to bonds for years now, and now it's positive. And that was a big change. This is one of the reasons that so much money is staying in these bond funds.
We would have thought that the Fed being too tight would have sent more of an unemployment. We expected to see negative payroll prints. We didn't. So partly we're saying maybe that neutral rate is higher, and perhaps that these rates will stay a little bit higher for longer. But in the book we did talk about reasons for it to go back to what you said, 0 to 50 basis points.
And Jeff, isn't it possible though, sort of along with Emily was talking about, that inflation might just continue to recede as fast as it sort of came in? Is there any case that we can make you on that? I mean, weren't you and I talking the other day, output prices for manufacturing PMIs? Manufacturing's in a recession. The U.S. economy is not, but manufacturing, which is a small part of the economy, we all work in services now, manufacturing's a crappy
It's
now.
a small part of the U.S. economy, but it's a big part of the German economy. It's a big part of the Japanese economy.
Is Germany in a recession right now?
Yeah, Germany's in a recession right now. Japan is going to see a negative GDP print this quarter. The UK is probably going to see a negative print. So that's 3 of the 5 biggest economies in the world, and China's not doing so great either. So we are looking at least a mild global recession from that perspective. We're used to a downturn being manufacturing and services. Right. And trade, and construction and retail, and that is not what this one's about. It's concentrated in manufacturing and trade. So those economies, very sensitive to manufacturing and trade, are feeling it. I've been calling this a cardboard box recession, because literally, if whatever we make gets put in a box, what do we ship gets put in a box, and so if you can put it in a box, it's in recession right now. If you can't, it's not. And literally, cardboard boxes are in recession. Corrugated fiberboard, Bob, which is what we made cardboard boxes out of. Demand for it has fallen in line with the prior recession. So we're literally in this cardboard box recession affecting some economies more than others. That should keep inflation down here in the near term.
I want to move on and talk about whether the Fed's going to tighten or keep tightening, or they're going to stop one more time. What I sort of see here generally, I see higher yields generally, even this month. I see higher oil prices, which is remarkable considering China's a huge part, second biggest economy in the world, and demand seems weak, and yet oil's holding up. And I see the dollar keep rising. So I see 3 things that kind of say to me that, slight warning signs to a certain extent. How does that sort of play in? This tells me there's further tightening on the U.S. economy to a certain extent. I don't know. Higher oil prices are a tax on consumers to me. I don't know, is that a stupid way to look at things, Emily? You're looking at me like, no?
No. I think that's right. And I think what's happening right now is we're getting these reads on things like ISM services, 54.5 last week. And you saw the 10-year Treasury yield just back up like this. Initial jobless claims coming in at 216,000. That's the lowest level since February. So what's happening right now is the consumer and the services side, which is related to the consumer, is holding up okay. Why? Because everybody has a job. okay? But what's happening underneath the surface is something a little bit more sinister. The cracks are getting bigger in the labor market. So we look at things like job openings. They peaked at 12 million last summer. We're at 8.5. Still elevated. You look at things like challenger layoff announcements. Last month was 75,000. That's versus 23,000 from the prior month and 20,000 from a year ago. The quit rate at 2%, that's back to pre-pandemic levels. So the way to think about the quit rate is there was a period over the last couple of years where you could leave your job easily and go somewhere else and make more money. Everyone's like, yeah. So sorry to break the news, but that period is behind us at this point. So we're seeing, the consumer confidence survey telling us that jobs easy to get or jobs hard to get measures are going higher. So the challenge here is that markets are repricing better growth at a time where the economy might not be quite as good as expected. And this is the normal order of operations. I didn't really mean to use another math analogy, but the way that this typically works is the Fed raises interest rates, the cost of capital for businesses and consumers goes up, and revenue growth starts to slow. We just saw revenue growth nirvana as a result of stimulus.
This is really important.
Yeah.
I just want to add on to this because cash deposits in banks for corporations is plunging, and that's usually got a good 9-month lead to jobs, and it started to fall down about 5 or 6 months ago.
Why is there a lead there? To explain that. Cash deposits are plunging, and why is that an indication of jobs?
So as revenue begins to fall off, well, you got to begin to cut costs.
Corporate revenues.
Corporate cash deposits in their corporate checking accounts, right, and business accounts, and that's where you're going to fund your hiring out of. 70% of the costs are hiring.
Yeah.
Listening to earnings calls, I just do a little text search, right? Talks about job layoffs or furloughs or headcount reduction versus hiring or jobs hard to get or difficult to fill positions. And we've gone from a shortage to a glut of workers. And that's usually got a lead of about 6 months into layoffs. So we are getting to where maybe the fourth quarter, we really start to see suddenly a much weaker labor market that'll feel like it comes out of nowhere, but there's actually been a number of those leading indicators.
I'm getting the feeling that they're trying to talk past the soft landing story, which, by the way, has been working, right? I mean, isn't it a little, amazing? The last thing on earth anyone was going to bet on 1 year ago was the Fed would engineer a soft landing.
Well, Bob, let me say, that's the U.S.
Yeah.
We are seeing a mild global recession. I mean, Germany, the UK, Japan, China, I would argue, are in a recession right now. And I think that's part of this global picture of weaker cash deposits, right? Weaker sales to...
But I want to focus on the U.S. The U.S. economy, it seems really strong.
Always want to focus
right
on
now.
the U.S.
I do. That's right. Well,
I tried to give you an opening to talk about international.
I'm sorry. It's 40% of the market capitalization of the global stock market.
You're forgetting.
I can't help but think, I'm trying to look past the soft landing. So those of you who think that market prognostication really works, a year ago, we were going to be in a recession at this time. Estimates were dropping dramatically, and the S&P was down 20% last year, and it has not happened yet. So what this tells you is be very careful about basing any of your allocations on stock market prognostication. This is why I stay invested longer and don't worry about this that much. But I want to get to the point about the soft landing. So far, this is what's happening, and yet, look out 6 months from now. Are we going to see something different going on? You seem to be thinking we're going to see signs of softening beyond just this corrugated box recession that you talk about.
I do. I think it'll broaden a little bit, but I'm not worried about the economy. European stocks are outperforming U.S. stocks this year. Does anyone know that? Is that a shock
on a currency
to everyone?
adjusted basis?
Wait.
Yeah.
Well, hold on. The indexes are not.
Yes.
Are you talking about equal weight kind of stocks?
I am. I'm
Okay,
talking
this
about
is where the strategist gets starts slicing and dicing things very finely.
Well, let me tell you why I'm slicing and dicing. So
the indexes are not outperforming.
The average international stock is outperforming the average U.S. stock, not only overall, but in every sector except tech. And the reason I think that's important is because there's 7 mega cap tech stocks that drive everything. I will operate at the asset class level. So if you want to ask me U.S. international, large versus small, growth versus value, tell me where 7 stocks are going to go. That drives everything. I got to look beyond that. Where is the average stock going to go in internationally? The average growth, the average value, the average small, the average large. That's where I operate. And that's where I'm seeing something I think is going to surprise a lot of people, where international stocks outperformed last year, outperforming again this year by a very large margin. Since the market bottomed in October, you're talking about over 1,000 basis points of outperformance by the average international stock, totally off everyone's radar screens. I think it's going to become more and more
Do people
evident.
own equal weight indexes, Jeremy? I don't.
Well, they
it's pretty
do.
small.
People have been concerned about the valuations in the mega cap tech, and I think even just the last few weeks is one really big example of that. You had the blowout of all blowout reports with NVIDIA, right? NVIDIA is like the prime stock with AI is driving all of tech generally, but it's also the most expensive stock of the S&P 500. It was 40 times sales, 25 forward sales, and it blew out earnings again, yet is still $50 lower than the after-hours trade, which goes to the problem of when you get such high inflated multiples, it becomes hard to keep beating. If you looked at the tech sector, it's about 10 PE points higher than the X-Tech. If you sort of group sort of the old tech classifications and the new with how S&P does it. And so it's just much harder for those to keep winning. Now, they did, the last 15 years, tech did deliver on that earnings growth and the sales growth, and it was one of the best decades for tech earnings, but can they keep
does
doing
it bother you, as the guy who wrote the book, Stocks for the Long Run, does this seven stocks concentrating owning 30% of the S&P 500, does that bother you? I mean, we've seen periods where there's been heavy concentration before.
The concentration itself doesn't. The valuations and what's baked into those valuations is where it gets tricky. And so you can't, I don't know that that there is that same growth opportunity to deserve a 10 PE point premium for 40% of the market. Can they really grow share and earnings enough to justify the whole tech versus X-Tech? So if anything, I'm with Jeff on this value tilt, international. There's places, we like Japan, which is a 12 times earnings, 8% earnings yield for some of our value-oriented strategies there. That to me, and that's doing, it's almost like an AI stock this year, but from a value base.
So I think
Hold on one second. I want to try to get some actual real investment advice here. You like Japan? Did you just say that?
Japan is still one of our top ideas. I've got the Buffett endorsement behind it. Like what could get people back into Japan? Buffett coming back to Japan is getting people. It's his second top country. He bought all these trading companies which have a commodity bent to it. And so that's
you're speaking like somebody who actually would own a Japan ETF. Oh wait, you do own a Japan ETF. Here's your shameless plug for the Wisdom Tree, Japan equity hedged. Currency hedged. Explain what that is to the audience.
Yeah, it's exactly how Buffett did it. So when Buffett went, he issued debt in yen so that he didn't have any fluctuations on that. And that was his main idea was, hey, I think these stocks are cheap. Who knows what happens to the currency? And he sort of took it off the table. So you're getting a 5% carry trade on top of owning the stocks. Now, people say, oh, the Bank of Japan is not happy how much it's weakened. Maybe they're going to get rid of their negative rates, and maybe that gets the yen to go positive. But you get 5 to 6%. So you need to see the yen maybe 140 or below to sort of break even on what you're collecting on interest rates.
You didn't plug the Wisdom Tree. Japan
Talking the concept.
ETF.
DXJ is the ETF that does.
I'm sorry, say that again?
DXJ.
This guy is
the ETF.
lousy at plugging his stuff. You got to do a little bit better on this. Come on, I gave you an opening. You didn't even do it.
Thank you.
Can I give some John Hancock ticker symbols?
We're going to get
I've got
there.
my
We're going to get there in a minute. Okay, so
There are compliance officers in the crowd. I just want to be sure first.
You like Japan. Emily, you continue to prefer U.S. assets in our discussion that we had.
Oh, yes.
And the U.S. dollars on a global basis. You
Yep.
talk about high-quality U.S. stocks. So what are you telling
Yeah,
everybody?
so our preference for the U.S. over international equities, and by the way, we still have international, we like developed over EM there, is really about our preference for quality. So we're in this late cycle environment where the cost of capital is becoming a massive issue for companies. Remember, interest rates were 0 18 months ago. So companies are now contending with this. So what we want to own are companies with great balance sheets, tons of cash on their balance sheet. Think about a company that has a limited need to tap the capital markets in order to be profitable. And frankly, the poster child for quality is the US technology sector. I'm not talking about your unprofitable growth at any price type tech names. I'm talking about Microsoft and Apple, essentially. So that's really a key element there. We also recognize that the valuations are extended there. So that's the part of the portfolio we're using to protect against solvency risk, but there is a valuation risk as well. So we've combed through the US equity markets across size and style, and we've identified that US mid-cap equities are actually trading not only at the biggest discount to their large cap counterparts since 1999, but also at a significant discount to their own long-term average at 14 times forward earnings.
You're talking about
versus
mid-cap
16.
tech or just mid-cap in general?
Just U.S. mid-cap equities. They're also benefiting from a big theme that we're keeping an eye on right now, which is onshoring or reshoring. So the reason that we're overweight U.S. mid-cap stocks and underweight emerging market equities is because, and I'm borrowing this from Nancy Lazar from Piper Sandler, our favorite emerging market is Middle America. And that's because of this industrial revolution that's taking place in the US right now around building, around infrastructure spending, and that benefits mid-caps because they have a relative overweight to the industrial sector.
I want to get back to the onshoring, but Jeff, I want to get your picks too. I know you in your 2023 outlook, you said international stocks were going to outperform again. Now, I know we just had this discussion. The average European stock you're saying is outperforming the average US stock this year, but in general, people usually buy these indexes that are market cap weighted. Do you still feel international is a better place to be?
I do, although I got to tell you, I don't know where those 7 stocks are going to go. So if you have super high degree of confidence on those 7 stocks, then you can decide growth, value, large cap, small cap, international, U.S. I'm focused at the asset class level. I think we've turned the corner on the cycle. And this cycle, I think, is likely to favor international equities, in part for one of the things Emily talked about, cash flow, low price to cash flow stocks, what I call short duration stocks, have been outperforming for a couple of years now. We've been focusing on that as a key factor, as opposed to thinking about sectors or style, really focusing on factors like low price to cash flow continues to reward investors. You're going to find a few more of those companies in each sector outside the US than in. That's a dominant theme for us. We like Japan. But international, I think, is a longer term story here, and one off so many investor radar screens. So I want to keep focusing on that. And I think implementation this cycle, equal weight, fundamental weight over cap weight.
I want to bring up a topic we haven't discussed, which is China, and this goes back to the onshoring question. One of the amazing things about what's happened in the last few years is it's not quite fair to call it the dismantling of globalization. That's not what's happening, but it's certainly becoming, the bolts are getting a little looser on this. And one of the big advantages, those of you who don't study this, globalization, is it's kept inflation low by concentrating production in very few areas and increasing the supply lines and the ability to move in between that. We have kept inflation lower because it's more efficient to operate that way. Now, as Emily was mentioned, this word onshoring means less efficiency, potentially means more capital investment, potentially higher inflation. Maybe we can chat about that for a minute. What's interesting to me, and maybe Jeremy can comment on this, was 10 years ago, the discussion we were having in the investment community, in the ETF community, was very simple. The question was, how do you weight China in a global portfolio? Most people were saying, okay, if China is 20% of the global market, you need to have 20% of your money in China. The only people who disagreed with that were the value guys. The value guys didn't give a damn about weightings. All they cared about is if Hong Kong is 14 times forward earnings or below, they buy. If it's not, they don't care. Now there's a whole other discussion about whether China is even investable. Part of this is political. Part of this is what's going on with Xi Jinping over there and the hard left he has taken with China's economy. But I'm wondering how you feel about that. Is China investable now? What does that word even mean at this point?
And being trained by Siegel, which is a notable value investor, when you hear uninvestable, that's what they were saying about energy when oil went negative. Like you couldn't invest in energy. It was one of the best times to be an energy bull. And you say, well, is now all this talk of China being uninvestable, the valuations start reflecting that, and then it does become a very good opportunity. But I am definitely a bit also share those concerns that things are not going in a trajectory where there's going to be less tension over the next decade. I mean, it's going, if anything, the only thing Washington agrees on is who could be more antagonistic to China. And so, I mean, you saw the headlines last week on Apple, and we thought that was an overreaction, that the government workers were already not buying Apple iPhones, so that wasn't really a lot of new news in some of these headlines. But you expect to see more of these headlines play
That
out.
headline, while it wasn't news, accomplished what they wanted. I think the Chinese
7%
wanted.
fall in
Oh,
2
we
days.
covered it like it was news, and then afterwards we said, you know, we sort of know this. Oh, by the way, this has been sort of the policy but we covered it like it was news. So
Right.
it got what they wanted. The Chinese government
Like
wanted.
Apple was gonna go out
Can
of
we remind
business?
everyone that we could cut this thing off really fast? So I'm sorry. Go ahead.
I was going to say, everybody was acting like that day, like Apple was going to go under or something. I mean,
Almost 4% that day.
ooh, yeah, I mean.
I think you can look beyond China. So generally, you're talking about EM investing, right? Very few people invest directly in China or buying Chinese equities. So you're talking about, should you have an allocation to EM? I think increasingly there's a lot of value there. India is a real interesting story there, really picking up. Just with the G20, another example of that, winning a lot more business from Apple, other places as well. So they're starting to build manufacturing. India's a service economy, starting to move into manufacturing, a long runway for growth, young population, highly educated, a lot going on there. Latin America is looking a lot better. So there's a lot more going on in EM. For a long time, 20 years, it was just about China. There's more to that story now as China shrinks as a part of that index.
But it's still a third, so it's still a
third.
meaningful thing. So if you're going to allocate dedicated, there's going to be more and more people looking at ex-China. Is my feel is one of the ways.
But Emily, I wanted you to talk about the onshoring thing because I think that's really critical. If all of a sudden Taiwan Semiconductor has got to build new fab plants here, that makes it less efficient when if they could just keep it in Taiwan. Everything comes right out of Taiwan. It's more efficient. Now you start breaking down production in different parts of the world. That's less efficient, potentially higher inflation there. I mean, what's the implications of that? It is good to... What's happened, folks, is they have decided that this is a national security issue. Pharmaceuticals, access to pharmaceuticals, access to semiconductors are national security issues. That's what's happening. So I'm not suggesting we should ignore it and not have onshoring as you're talking about, but this is something big is happening that's changing, that's kind of dismantling globalization to a certain extent.
It's huge. It's a massive, trend, and I understand the point about inflation and maybe some upward pressure on wage growth, but I have one word to respond to that: robots. Right? So artificial intelligence is putting massive downward pressure on inflation, and a lot of jobs are being, think about automation. I heard that CNBC commentators, there's just going to be a robot doing that job.
Well, there already is. I actually, I'm still in Philadelphia. I just sent, if you just hit me, you get an echo if you hit me right on the arm here.
So
Emily might hit me on the
joke
arm.
about it, but this is really, really important in terms of a longer-term trend that I think could really counteract the potential upward move in wage growth and inflation here as a result of this onshoring trend. Remember, nothing much has changed in terms of what's happening underneath the surface in the U.S. economy. Demographics are playing a big role. Technology is playing a big role. I think we go back to low growth, low inflation.
You mentioned, I'm going to just tell you a quick story. You mentioned AI and how it could affect the financial reporting community, which is me, by the way. AP now has an AI service. So, for example, every month you have new home sales. So you have these basic data that we go over. AP now has a service whereby it will scrape the data. So the Bureau of Labor Statistics put out the data, and you can scrape it. It'll literally go right onto your computer. And AP has a AI that constructs a paragraph that says, new home sales today rose 3.2%. This was more than analysts had expected. And it's a paragraph, and it's done by a machine. And I read it every month only because this is my competition. And you know what I think? I think that if I had only one paragraph and 5 sentences or 6 sentences to write about, that's as good as I would have done. It gets all the facts. Now, what they cannot do yet is the nuances of like what we're doing here, which is high-level analysis. It can't do that yet. But if you think that that's impossible, you're kidding yourself somewhere in the future. So I already see the competition on a daily basis and what's out there. Let's just talk about AI because I'm sure people are concerned. We've had technology taking people's jobs for 200 years since they invented weaving looms. Automated weaving looms, 200 years ago. Is there something fundamentally different going on, or is this just part of the long process of technology making things more efficient, and people will find newer jobs?
It's amazing. If you look at China, in 1991, 60% of the population was in farming. It's around 20 now. So just at 30 years, 40% of the world's biggest population being replaced by technology, right? So that's a classic example, but there are many of them. We can measure this. We know what impact it's going to have. All we have to do is look at the amount of investment in information processing technology and software, and that usually leads to a productivity boom a few years later. I don't know if it's going to be a few years, it could be 6 months, it could be faster this time, but we know you've got to have the investment first. We saw it with global positioning systems, we saw it with the internet, we saw it with computers. So we know how to measure this. It hasn't even started yet. ChatGPT was November. So we don't yet know what kind of displacing productivity effect there will be, but we can begin to track.
But Jeremy,
And
ChatGPT was part of a long tradition of new technologies that have come in, right? It didn't just come out of nowhere. I mean, software as a service has been around for 20 years. It's been replacing back office jobs for years and years. We didn't call it artificial intelligence. Right.
Well, this is a key part of the initial conversation we were having with Emily of like, where is that real long-term real interest rate? Real interest rate should proxy real economic growth. And real economic growth is how many people are working and how productive are those people. So if, the last decade was a very disappointing decade globally, where productivity was only 1%. I mean, it used to be 2%. So will AI bring us back to the old normal? Or are we stuck in this sort of slower growth, slower productivity, which gets back to a much lower real interest rate? But
right. This gets to the point, though. Should we be afraid of AI, that it's going to take our jobs, that somehow look, the point is productivity. If people want to make more money, you have to be more productive. The money doesn't come out of nowhere.
And for the workers, we've seen. Actually, even the workers in China who stayed in agriculture, their wages are higher as a result of this productivity.
So now the argument is, okay, it's different this time, Bob, because yes, 200 years people have been replacing technology, have been replacing jobs, but this is going to replace an awful lot of jobs. Is that a legitimate worry?
I think it's building on Jeff's point about changes in industries. I think it ultimately creates new jobs. It creates new jobs in new fields, and it ultimately causes our wealth to be greater over the long term. Corporate profitability is going to absolutely benefit from this. This is a long-term theme that I think is going to be a positive one, not only for wealth, but also for corporate revenues.
Well, 50 years...
If it doesn't take over the world and kill us all.
50 years ago, I was in college, and one of my jobs that I was a telephone operator. So people would call into the building and say, I'd like to speak to room 210, and we pull the wire out of the wall, you stick it into the plug. And you know what happened? At one time in the 1930s, 40s, and 50s, there were 500,000 people, mostly women, employed as telephone operators. And that job, since the 70s, I was one of the last people to ever do that job. It's gone away because there's software that does that now. You don't need to have somebody physically connect anything.
Was it tough outrunning the dinosaurs on your way to work?
Thank you for bringing that up, Jeff. I appreciate that. Remind me about next time inviting you to the last panel. So the point is, what happened to all those people? Where did they go? And the answer is, they found other jobs. They moved on. But it's hard to talk to the naysayers who say, oh no, Bob, but this time it's really going to wipe out everybody's job. This is bigger than software in telephone operators at this point. And I just don't believe that. I really don't. There was a survey that something like 60% of all the jobs did not exist in 1940. The job descriptions for 60% of the jobs existing today did not exist in the 1940s. They're all new. There were no software developers in the 1940s, and I'm just picking one. There's dozens of them. What else? We've got 3-4 minutes left here. I just want to get to a couple quick questions here. What would need to change in the economy for younger Americans to be able to afford housing? We haven't talked at all about housing. Somebody want to hit on that?
It's the Fed's fault. They need to bring rates down.
Right. Yep.
Productivity is going to be key there, and we'll have to see where it goes. All comes down to wage.
Anything else? You want to say anything on housing? Even if the U.S. does not experience, I'm reading some questions here, even if the U.S. does not experience an economic recession, do you think there will be an earnings recession? Are U.S. equities priced to perfection? We're 18 and a half times forward earnings now? That's on the high end, but not ridiculously high.
So I just want to say this, because you talked about soft landing a few times and no landings coming back into the narrative. That's not like a thing, because we would never have economic cycles if there was no recession. So it will play out at some point. It's all about the timing. What we've actually seen recently on the earnings front is a repricing of earnings growth higher. We have to remember that we've pulled forward a ton of earnings growth. If you look at 2020 through 2022, we've averaged 20% earnings growth per year. That's a lot, as we had this huge tide of stimulus. Companies didn't actually even need to do that much to generate the 20% revenue. We also had, growing deficits. We had lower taxes for corporations, lower interest rates. All of those things, in my view, are kind of moving the other way here. So I think to anticipate record high earnings growth, in my book, is a little bit optimistic. So you want to look under the hood, find those higher quality companies, find those value opportunities, and even look to more defensive equities to ride this tide out.
One last thing, since I have Professor Siegel's greatest disciple here, market timing. The pressure for people, it seems, to go in and out of the markets all the time is very high still. And yet we know about the folly of market timing. We know most of you can't do it. We know even professionals can't do it. And one of the values of Jeremy's book is stocks for the long run. It talks about the great returns, but only over long periods of time, not on a weekly, monthly, or even yearly basis. Can you just address that as an educational point for everyone?
Well, and people talk about now you can get 5.5% in treasuries. Is that something people are more competition for stocks? And you say, well, people don't think that 5.5% is going to stay at 5.5 for long. For now, yes, but soon we'll be cutting rates. And so it's really those long-term bond yields, 2% on the 10-year tips versus, call it a 5% earnings yield, which we think is a real return predictor for the next, call it 7, 10 years. So you get 5% plus 2 to 3% inflation. You're talking 7 to 8% in stocks, 2% real in bonds. We still think stocks are good long-term if you could hold it for the next 7 years.
I agree. My view is 12 to 18 months, just to be clear. I'm a perma-bull.
We're going to have to leave it there. Our time is up. I want to thank Emily, I want to thank Jeff, and I want to thank Jeremy for stepping in at the last moment. One final talk about shameless plugs. I have a book out, Shut Up and Keep Talking, about what I've learned 30 years covering the stock market at CNBC. My publisher, Harriman House, is kind enough to be here. And I'll be happy to sign copies of the book for everyone. They're going to give them out. They're bringing bunches of them at stand 521 in the next 5 or 10 minutes. So if you want to come over and say hello to me, and happy to chat with anybody who wants to talk about investing. And thank you all for being at this wonderful conference. The weather has come out, and hope you enjoy it. And remember, Method Man tomorrow night, G Love and Special Sauce tomorrow night. I'll be here. I hope you guys are going to be here. Thank you all for joining us.